Good morning. Good to have you on the show. Vinit, want to talk about the outperformance that we've seen from the broader end of the market, especially year to date, month to date. Pick up any timeline and you've got the mid and the small cap indexes outperforming what the benchmark has done with a gain of about 13% year to date. Do you sense that the outperformance is here to stay? Because we've also had a lag of the last 2 years from mid and small caps, and there is a fair amount to actually catch up to.
Yeah, so good morning and thank you for having me on the show. So I think it's very difficult to predict really in the near term as to how the stocks are going to actually move. And more importantly, if we actually look at what has happened is we are just coming out of this financial year 21 results being announced by the corporates. And I think given what we had witnessed in terms of the pandemic, the corporate scorecard has been pretty reasonable in terms of the growth in terms of the business profitability growth. The corporates have done a really good job. Beyond that, what we've seen that as far as the recovery is concerned, it was more broad-based, and I think that was really picked up quite well when we see the broader markets actually doing well. So I think that was pretty reasonable. Also, it is followed up by a lot of interest being shown by the retail investors, who are becoming very enthusiastic because, the markets have only delivered positive returns, not really seeing the other side of the story. But I would say that this is a time to remain a bit more, let's say, sensible and cautious in terms of what one is looking at and what one is buying. While we have a good long-term view around the markets, and we definitely feel now we have more legs for growth. The economic growth will be more broad-based given what is happening in terms of the spend. The private capex is improving. But nonetheless, I think it is also important to notice that drifting a lot in terms of low quality can cause pain as well. And hence it is important that we preserve or conserve capital and be with good quality names. So I would say to your question, I think there is, more, we believe that there are opportunities in the broader market. More sectors are likely to do well over the next few years, but one needs to be more sensible in terms of what types of businesses one is actually buying.
Sure. The one play which has really come to the fore, Vinit, has been sugar. We were just looking at the year-to-date returns itself from some of the sugar names. And across the space, now especially with the ethanol story as well playing out, almost triple-digit run. Pick up any stock and that's been holding up and really been on the tear. That along with, of course, infra stories like a Praj as well, holding out well. Do you believe that within the small and mid-cap universe, sugar is a story which is seeing a re-rating process of sorts, and the gains are here to stay?
So I would imagine that one part of that big gain is done, and there was a long wait before we really saw the sugar cycle playing through. And we've had, really in the past 2 years, one or two clear false starts. We felt that the cycle will turn, but the holding phase was a bit longer. But anyways, now as it turns out, what is happening is that, there is, a lot more focus on blending of ethanol, and which is actually leading to more usage of, let's say, sugar towards ethanol, not only in India, but globally. And that is, let's say, causing some bit of adjustments to the sugar inventory, which generally remains positive for the sugar prices. So I would imagine that, we have, committed to have some blending norms over the next 2 years. And if we were to really follow those norms, there would be, the positive cycle should continue in my sense. Because we are seeing the sugar price actually moving after many years of remaining subdued. And also as the inventory adjusts to a reasonable level, that will mean that the outlook for the industry will sort of remain positive. Plus the ethanol is anyways good contributor to the profitability for the companies in itself. So I think overall, on the whole, I think the sugar cycle is looking strong and looks like will continue for the next 1 or 2 years.
Okay. Vinit, if I take a look at the recent buys and sells, I see a clear shift towards discretionary versus staples when it comes to the broader consumption pool. Is there a clear line of thought there? Do you feel that there's very limited room for growth on staples? But more interestingly, are you bullish on demand coming back when we look at discretionary?
So I would say that while structurally discretionary has slightly more room to play because you have a premiumization story there happening, you still have a lot more unorganized to shift from organized, and the pace of which has got accelerated because of the COVID impact. And anyways, what is also happening is that because the work from home culture has picked up, there is a lot more demand for having the demand for your, let's say, the home products, which has increased. The need to have all the facilities at home has also gone up. So I think all those is actually leading to better demand prospects for the discretionary side of the story. But on the other hand, one should also recognize that the valuation is something which one should remain conscious about. We feel the valuations today are building in some bit of that recovery, and we like the discretionary story over a longer term. And compared to the staples, probably we believe relatively that's one segment which should do well. But you like to look at those spaces in weaknesses clearly, because we feel that the valuations are slightly on the higher end, and that's the sort of a view. So I think the long-term picture remains positive, but a bit skeptical right now in terms of the valuations on the discretionary side.
Okay. What about healthcare, Vinit? It still remains a very, very small part of the portfolio compared to some of the other sectors. Is there a reason for that? I mean, would you look at expanding some of the holdings within the healthcare segment, or is there a reason that perhaps you're holding back?
No, so as far as it's actually a mixed exposure across various funds. The mid caps and the small caps has seen some bit of profit taking in the last 5 or 6 months because we had seen massive gains. But on the whole, if we generally look at our other funds, and if we also have a dedicated healthcare fund, we have again a positive view on the sector, because we believe that the sector is more like a non-discretionary consumer type of a business, where today we have seen some bit of imbalances being caused because of the COVID, where the demand for, let's say, COVID and COVID related drugs have gone up, but it has led to cut in some of the acute therapies, and it has led to also patients not being able to sort of, let's say, reach out to doctors, or they are holding back in terms of the surgeries. So I would imagine that as we normalize, some of these would sort of come back. The other important piece in the healthcare remains the US piece or the international piece, where the Indian companies definitely have created very strong competitiveness for themselves. And that's one piece where I think we had seen challenges in the past, and now I think in terms of the pricing pressure, those are also easing off. That's the second aspect. And I think thirdly, more and more companies are looking to specialize their offerings when it comes to the international market. So I think all of these taken together will mean that over the next few years, the outlook for the sector should be good. The sector has seen the ROEs, come off, let's say, from the highs of 17-18% to 11-12%, and we believe that there is a possibility of reversion on the upside for a few of the companies, and hence we hold a good positive view. In the funds where there are, let's say, we have taken profit out in the next few months, as the stock, let's say, goes sideways and it again becomes attractive, we are open to sort of looking at few names to add back into the funds.
Vineet, hi there. Good morning. Given that you did load corporate India for a decent set of quarterly numbers, what's the expectation going forward when it comes to the earnings trajectory? In terms of, are there any specific sectors that you're expecting strong earnings surprises, basis what they have delivered so far, as well as some of the lockdown restrictions, etc., having eased up?
Yeah, so I think still a bit uncertain in terms of the how the pace of the recovery is going to be, because I think post the first wave, clearly we saw the pace of recovery to be very strong, and I think the most important debate this time around is the fact that how strong the pace of recovery would be, and then there are mixed views because we all know that the second wave has been more widespread. It has actually, also impacted the rural and the semi-urban areas, which were one of the important drivers of demand post the first wave. So I think there are some of these uncertainties, but I would imagine that generally the corporate sector is, showcasing confidence about strong revival once the lockdowns open. And as I said, I think the activity levels have gone up across the board. We are seeing not only the government spends which are taking place, and despite the second wave, I think the pace of the work which was happening was very reasonable. Also, with the results, we've seen that the private sector, some of the heavy industries like steel, cement, refiners, they have come out and spoken about capex. So, there is a definite visibility of the private sector also coming out, and then the real estate is something which has caused some of the segments which are correlated to the real estate sector to do well. So I would say that some of these important factors have come together to, in a way, give confidence that the growth outlook for the economy should be better. Now, linking to some of these growth factors, I would imagine that segments which are linked to these sectors, the likes of, let's say, cement, engineering goods, the banking sector, for that matter, is something which in the initial phase we believe is likely to pick up much better in terms of the outlook. And then as the more employment is generated, incomes improve, and then the fear of corona actually comes down, I think the consumption should sort of follow suit. So I would say in that order, there is sort of preference as far as the segments are concerned. I would like to just also mention about the banking sector out here. One more point is the fact that after the first wave, the sector has actually shown very strong resilience when it comes to the slippages or the asset quality. We would imagine that again, due to the second wave, there would be some impact on the overall asset quality, but not a whole lot. We would say that with the economic prospects improving, the banking sector should start recovering as well. The growth rates should improve, and the asset quality will be sort of taken care of. The banking sector has adequately provided or provisioned some of the, let's say, impact which the COVID will have. So I would say that that's one sector which looks good in terms of linkage to the overall broader economic recovery, and which is where sort of gradually we would like to keep looking at that sector as far as our funds are concerned.
Vineet, many analysts are alluding to the fact that there will be lots more optimism for the road ahead when it comes to autos. Despite the fact that we did witness the impact of the second wave, the fact that the vaccination drive is picking up pace, there does seem to be a sense of pent-up demand kicking in. Is it looking promising, the road ahead for autos?
Yeah, I mean, see, currently, because the views today have again got clouded because of the second wave. We were anticipating pickup in the recovery for autos, clearly because the auto is one sector which is anyways got impacted because of COVID. But even before COVID, we saw that the sector had seen the impact of cost rising due to various regulatory changes which are happening. So I would say that the sector has gone through a deeper, down cycle before COVID and even post COVID, and now the second wave. So I think the outlook in the immediate term is getting a bit clouded. But I would imagine that the sector is looking good as far as the cyclical recovery is concerned. Once we are out of this, as more people come out and feel more confident, I think they are going to spend on the high ticket discretionary categories as well. And anyways, the dynamics of the sector are well placed in terms of the cycle lows. So we are sort of building in gradual recovery to take place in the sector. Currently, the passenger vehicle business overall looks, and the CV business is looking cyclically far better than the two-wheeler business. But also, one should keep in mind, if the valuations in the two-wheeler becomes attractive because of that, it's also going to be good to look at those categories as well, because we are again looking for the recovery taking place in that category as well. So I would imagine that it's a gradual recovery process for us, is what we are sort of building in for the auto industry.
Vinit, if there was one sector you had to pick as the prospective outperformer, let's give it a year's time frame or end of year or 1 year from now, I leave that to you. What would it be?
It's a really difficult thing to actually predict 1 year out, because today we are in such an uncertain environment. But I would imagine that the banking and the financial sector is something where I believe the outlook should improve, the credit quality should improve, the credit cost should normalize, and that's one sector where I believe the profit pools could rise, and which is where I think that there's a merit in looking at the sector and gradually increase the exposure is what I would imagine.
Okay, and Vinit, we always ask our guests their advice on how to get rich for all those young investors out there. So what would you suggest, or how would you put it in simple terms?
I think it's a very simple formula. Getting rich is a very gradual process, and one needs to have patience. In fact, you mentioned about the young investors. I would really advise that these young investors should keep a 20-25 years time frame. Start investing in any good funds they like. Start with SIP, and just open the statement after 10 years and do not look at the statement for the next 1, 2, 3, 4 years. I think that's the sure short way of getting rich is what I would sort of advise.
Okay, point taken. And Vinit, what's the sense that you're getting when it comes to the advice for central banks? How have you looked at the Fed's recent moves and how we're tackling inflation as well back home?
Yeah, so see, I would say that one should, so there is a lot of fear around the fact that, there is inflation which has happened globally across commodities. Interest rates have started looking northwards. And that's the fear even sort of happening across various economies, and which is what we are actually witnessing. Because of this fear, there is capital flight which is taking place back into the US markets. So I would say that these are let's say unavoidable. It is just a matter of time. Not the debate is not whether it will the interest rates are not going to go up. The debate is that when it is going to go up. So one should be prepared for it. But one should also look at the factors which are sort of driving those changes in the economy, and the factors are more fundamental in nature. I think most economies now are spending a lot to focus a lot more on the recovery prospects of their economies, and I think that's a good thing to happen, because fundamentally what's going to happen is that because of the spends which are happening globally. The corporates generally are going to do well. Some bit of inflation and some bit of interest rate in the initial phase is always healthy, because it leads to that optimism because of the revival. Generally, definitely drives some bit of that interest and inflation. That is good. But eventually, as it starts hitting up and it starts going up, the in the latter phase is something where one should really be worried about. But for now, I would say that if the factors which are going to be driving the growth in the economy, if those are being put in place well, I would say that's a job well done. That will take care of the growth, and that will also mean that some bit of inflation and interest rates will be high. And the other thing which I wanted to just add also is that we should also recognize that significant part of the inflation was also due to the supply chain impact, which most of the commodities or most of the products today are facing because of the COVID. As the supply chain bottlenecks starts easing out, I think some bit of the inflation should also get under check, is what I believe. So I would say, all in all, it's not looking like a very bad impact. It's just that the economic revival should also take place along with some of these changes which are happening.
I heard. Vinit, it's been a pleasure chatting with you. Thanks so much for sharing with us your outlook on the markets.